chapter, that is verification and valuation of assets and liabilities. This concept is very important in auditing. This chapter mainly focuses with how the auditor will be while doing the auditing, how the has to verify the assets and liabilities in the company before going to be verification. If you talk about the any debit and credit side of the cash flow, we consider as coaching. If you talk about any assets and liabilities in the balance sheet, will be considered as verification and valuation. So let us see the meaning of verification. Verification means defined as a process by which the auditor substantiates the accuracy of the right hand side of the balance sheet. It means it is the process of auditor would be verifying the right hand side of the balance sheet. We already know right hand side of the balance sheet consisting of all the assets of the company. Assets may be a fixed assets or it may be the current assets. So it consists in three main distinct objects. The first one, verification of the existence of assets. Existence of asset that has to be physically verified by the auditor, or else sometimes the company are showing the any fictitious report payments in the balance sheet that can be verified by the auditor. The second one, valuation of asset. Valuation of assets should be known by the current price of the asset be known by the auditors in the company. It means, for example, if I take the building in the previous year for rupees 20 lakh, but it can be reduced to value of rupees 5 lakh because sometimes it may be the inflation price or it may be the economic causes. The current price should be known by the auditor. The next one, authority of their acquisition. The auditor has to check the name of the authorized property. Means auditor has to check the existence of assets and valuation of assets along with the authority of their acquisition. Rather than these three objects, the other objectives are considered by the given by the Chartered Accountant of India. The Institute of Chartered Accountant of India states that verification of assets should be aimed at establishing the first one, existence. They physically verify whether the assets are exist or not. The next one, ownership. This building is completely relating to the company or not. That also verified by the auditor. Or else sometimes the company is taken as a lease or rent basis, but the company is recording as the real owner of the company. And that time the auditor has to check whether the company building is to be related to the company or not. That can be verified by the auditor. The next one, possession. See, here ownership is different and possession is different. Possession means when we are entering into the agreement, we consider as possession. For example, if you are taken as a lease or rent basis, will be considered as possession. But in the case of ownership, it covered all the dues without having any debts. That is called ownership. The next one, free from encumbrance. Encumbrance in the sense of obligations. It means it has free to use. Whenever we stated this assets is belongs to me, it does not having any debts. That is called free from obligation or is free to use. That is called free from encumbrance. The next one, proper recording and proper verification. The auditor should verify the recorded asset physically as well as documentary in the auditing time. The next one, what are the difference between verification and watching? Before going to see the difference, let us see the meaning of watching. Watching means it's a documentary evidence. We have to check whether the receipts and payments will be matched to the books of account, and the verification, existence and ownership and along with the book of account. We'll see the difference. The first one, watching proves the accuracy of books of entries, but certifying on balance sheet can be made only after verification. See, in case of poaching, it proves accuracy regarding recorded entries in the books of account. But in the case of verification, whatever we showed the amount in the balance sheet with regarded to asset that has to be verified. After verifying the transaction by the auditor, it collected from the certificate from the certified valuer, then only it can be established. The next one, OCHIP examines the entries relating to the transaction recorded in books of account. But in the case of verification, examines the assets and liabilities appearing in the balance sheet. It means the auditor assistant should be cross-verify all the bills and document whatever recorded in the books of account. But in the case of verification, auditor should be verified all the assets and liabilities whatever we entered in the balance sheet. The next one, watching is done throughout the year, but verification takes place at the end of the year. Yes. Watching this can be done day-to-day basis transaction. People going to check. I mean, the auditor assistant going to check all the day-to-day transactions on purchase and sales during the days. But in the case of verification, when the company is going to be conduct the auditing, then only the auditor going to be check the all the assets and liabilities. The next one, coaching is based on only the documentary examination, but verification is based on personal as well as documentary examination. As in the case of coaching, the auditor assistant check the all the documentary evidence are like bills, receipts, and invoices. But in the case of verification, personal as well as documentary examination. Personal in sense of physically verify the all the assets because assets are tangible assets. So it can be done through personal as well as documentary examination also. The next one, it does not include verification. I mean, coaching does not include verification, but in the case of verification, also includes coaching. Why? Because OCHing does not include verification. OCHing is considered only the documentary verification, but in the case of verification, while doing the verification by the auditor, by the assets and liabilities, it can be physically as well as documentary can also be verified the all the assets and liabilities by the auditor. The next one, OCHing is normally done by the auditor assistant, but in the case of verification, is done by the auditor himself. See, here bills and invoices done by the auditor only by the assistant because auditor assistant preparing the financial report, then he can submit to the report to the auditor. Then he has to verify and he has to sign the financial statement. Then only it can be established in the financial statement. But in the case of verification, it is a mandatory duty of the auditor to verify the all the assets and liabilities. The next one, valuation. Valuation means estimation of various assets and liabilities. For example, if I purchase any asset for rupees 20 lakh, it cannot be expressed, it cannot be expected the same value tomorrow because of sometime it can be money value can be increased or sometime economic causes. So it cannot be expected the same value tomorrow. So clearly says estimating the present value of assets and liabilities called as valuation. The next one, what is the duty of auditor? See, the duty of auditor is to confirm that assets and liabilities are appearing in the balance sheet, exhibiting their proper and correct value. It means whatever we stated the assets value in the assets and liabilities in the financial statements, the auditor should verify whether the company is going to be recorded the correct value of all the assets or not. Here, because only assets can be valued but not the liabilities, he has to sign the financial statement, then only it can be published to the all the stakeholders. Next one, what are the auditor positions regarding valuation? See, the auditor can obtain the certification of value, then it could be proceed for preparing the financial statement. Without expert decision, the auditor cannot be prepare the financial statement. We'll see the auditor position. The first one, an auditor can obtain the certification of value and the other competent persons, but usually the assets are valued by responsible officials. An auditor audits many types of companies and he can't be an expert to value all kinds of assets. As auditor is not an valuer, the auditor can obtain the certification of valuer and he taken the guidance of the valuer and he can value the all the assets and liabilities. The next one, an auditor is not an valuer and he cannot be expected to act as such. As he is completed the CA, he cannot be acting like a valuer and all that he can do is and ascertain the as far as possible the current values are fair and reasonable and are in accordance with accounting accepted principles. It means the ascertained value of the assets and liabilities should be valued in fair and reasonable manner and it should be accordance with accounting accepted principles also. The next one, it must be borne in mind that the actual valuations are made by officials who have practical knowledge of such assets and that an auditor's duty is confined to testing the valuation as far as he can and in this way satisfy himself with correctness of the balance sheet position. However, he can't guarantee the accuracy of valuation. It means the valuation is done by the certified valuer can't be guaranteed by the auditor. Yes, because auditor is completely believing the value certified valuer information because he does not having the in-depth knowledge in the valuation. So it's completely within the whatever auditor valuer will be telling, we have to listen that. The next one, in simple words, in the absence of suspicious circumstances, it can rely on the trusted officials of the company, but this will not relieve him from his responsibility. If assets are incorrectly valued, he should exercise a reasonable care and skill, analyzes critically all the facts and satisfy himself that generally accepted. Accounting principles are followed. He should not certify what he believes in incorrect. It means if there is any suspicious information with regard to the valuation, auditor has to take reasonable care and skill, and that should not relieve him from the responsibility for the accuracy of information. These are the auditor position when the company is going to be doing the valuation procedure. The valuation procedure only done to the assets but not to the liabilities. We'll see the next concept. What are the methods of valuation? See, assets may be valued in any of one of the following methods. The first one, cost price. Cost price in the sense it is the price paid to purchase an asset, including installation and other expenses incurred to make the asset into workable condition. It means when we are going to do purchasing the any assets in the company, that time of expenses and assembling the asset and installing the assets in the company, that and all expenses will be considered as cost price. This is the one method we people are going to be value when the company is going to be conducting the valuation. The next one, market value. Market value in the means the value of which an asset can fetch in the market when it is sold. It means today's value will be representing as market value or present value of an asset, that can be considered as market value. The next one, replacement value. The replacement value, it is the price at which a particular asset can be replaced. Means the particular asset which can be replaced, the asset replacement value that should be known by the auditor itself. The next one, book value. It is the value of asset as shown in the balance sheet. It means what we are showing the amount in the balance sheet, that should be represented as a book value in the company. The next one, what are the difference between verification and valuation? See, valuation means certify the correct value of an asset, but in the case of verification, it consisting of existence, ownership, and title of the asset. We'll see what are the difference between verification and valuation. The first one, verification is done to prove existence, ownership, and title of the asset. Existence in presently physically its existence are not in the company, and ownership is completely related. That building should be completely relating to the company or not, or else taken as a lease or rent basis by the company. And the title of the assets means the property is completely relating to the company or not, that should be verified by the auditor. But in the case of valuation, it certifies the correct value of the asset at the date of the balance sheet. It means the auditor the auditor valuer means certifies the correct value of an asset. It can be analyzed. The next one, verification is done both assets and liabilities, but in the case of valuation, usually values the assets that are certified. See, if I taken as a loan in the verification procedure, that also can be verified in the verification process. But in the case of valuation, only the assets can be valued, but not the liabilities. The next one, verification is done by the auditor, but in the case of valuation, it's done by the expert and responsible officials. It is a mandatory duty of the auditor to verify all the assets. But in the case of valuation, it's done by the experts or responsible officials only, because auditor does not have the in-depth knowledge while doing the valuation. So that valuation procedure will be done by the experts or responsible officials or certified valuer. The next one, verification is made on the basis of evidence, but valuation is made upon the certificate issued by the officials. Yes, verification is made on basis of evidence. Evidence in the sense of personal, or it may be in the documental evidence also. Personal, it may be physically verified by the all the tangible assets, but in the case of documentary evidence, it can be checked by the all the bills and invoices along with the receipt. But in the case of valuation, it should be having the certificate given by the so and so company. I mean, the certified valuer given the certificate for to certify all the assets in the company. That is called valuation. The next concept will be discussed in the next class. Thank you.